Stop scrolling. Forget the charts. What just happened in the silver market is not noise. It is a structural failure unfolding in real time. The data pulled from CME servers today is not an anomaly. It is a historical rupture that permanently alters the silver market's foundation. For 48 hours, warnings were ignored. China's export ban was dismissed. The banks were assumed safe. That assumption just died. At exactly 2:30 p.m. Eastern, the paper market lost control. Physical demand detonated without mercy or hesitation. This was not hedging. This was not industrial flow. This was a coordinated assault on the exchange itself. The ghost of 1980 returned today, not as a memory, but as a living force stalking the trading floor. Back then, two brothers tried to corner silver. Today, it is something far more dangerous than cowboys. Today, the predators wear suits. They sit inside the vaults, and they know exactly what is coming next. The CME delivery report shows 1,168 delivery notices issued in a single session. That number alone should terrify you. Each notice represents 5,000 ounces of physical silver, not paper promises, not digital entries. In one trading day, 5.84 million ounces of silver were demanded for delivery, instantly, without negotiation. Zoom out just 24 hours, and the picture becomes catastrophic rather than shocking. Combined with New Year's Day, total contracts standing for delivery reached 3,446 in 2 days. Say that number slowly. Visualize it. 3,446 contracts demanding metal. Multiply by 5,000 ounces per contract, and the math turns brutal. 17,230,000 ounces of physical silver moved in 48 hours. Global mining produces roughly 800 million ounces per year. Do the percentage. In 2 days, before traders returned from vacation, exchanges lost over 2% of annual global supply. Factories do not place 17 million ounce orders on a Friday afternoon. That excuse ends here. This was a run on the bank, executed with precision and insider timing. January 2nd was not random, it was chosen. The China export ban went live this morning. The eastern supply wall slammed shut. No inflow, no relief, no replacement metal. Banks in New York understood immediately what that meant for remaining inventory. 39 million ounces in registered vaults became the last accessible silver on Earth. They did not hesitate, they did not probe, they smashed the buy button. Nearly half of available registered silver was stripped in just 2 trading sessions. At this pace, the exchange mathematically cannot survive another week. This was inventory liquidation disguised as normal trading activity. The most disturbing signal is not volume, it is intent. In 1980, intent belonged to speculators. Today, intent belongs to the banks themselves. The suppression cartel has fractured. Cooperation is over. Cannibalization has begun. Banks are no longer defending price. They are defending survival. Issuer and stopper data reveals allies turning into enemies overnight. Paper shuffling stopped. The metal stopped circulating. It began moving in straight lines. Out of one vault, into another fortress, no intention of resale. One major institution was forced to bleed millions of ounces. Another major institution stood ready, catching every ounce without mercy. This is what currency death looks like behind closed doors. The thieves stop stealing from the public and start stealing from each other. And this was only the opening salvo. Now the obvious question emerges: who was forced to sell, and who just swallowed the market in one violent move? This was not retail, not Reddit traders, not coin shops clearing shelves. The largest buyer of physical silver today was the very bank that built the paper short trap. They didn't panic, they pivoted, they flipped sides mid-war. This was a blue whale raid, executed inside the system, against one of their own. While headlines screamed volatility, a silent execution unfolded in the wholesale vaults. Millions of ounces never touched the open market. They were intercepted before daylight. One major European bullion bank became the sacrificial victim. Deutsche Bank was forced to deliver metal it could not afford to lose. Over 3 million ounces exited their control in a single session. That silver was not recycled. It was captured and removed from circulation. Former allies stood by, bucket in hand, collecting every ounce. This was not competition. This was predation. The gentleman's agreement that suppressed silver for decades just collapsed. There are no gentlemen left in this market, only predators and prey. And the prey was bleeding out on the floor of the exchange. As banks cannibalized each other, the consequences hit the real world immediately. The retail silver supply chain did not tighten, it collapsed. Online bullion dealers went dark almost simultaneously. Buy buttons vanished, notify me replaced prices. This was not a website glitch, it was a supply blackout. Major dealers who usually carry tens of thousands of coins were suddenly empty. American silver eagles went out of stock nationwide within hours. This was not a temporary outage or a holiday delay. The retail silver pipeline snapped instantly under wholesale pressure. Products didn't move to backorder status. They vanished entirely, as if they had never existed in the first place. Normally, dealers happily accept pre-orders and future deliveries to lock in customer cash early. But today, that behavior stopped cold, and that detail reveals the true severity of the situation. When a bullion dealer refuses future orders, it means they fear default more than lost sales. They are no longer confident they can replace the metal, even at dramatically higher prices. That fear is not emotional. It is mathematical, based on what just happened inside the exchanges. Only one category of dealer inventory remained visible, and it served as a warning, not reassurance. The so-called dealer of last resort still listed coins, but at prices bordering on disbelief. Random year American silver eagles were suddenly priced near $90 per ounce. Mint-condition coins pushed toward $95, signaling panic replacement cost, not profit margin. Meanwhile, the paper spot price continued flashing $71, creating a dangerous illusion of stability. That $18 gap is not a premium. It is the cost of scarcity being priced in real time. Wholesale silver has been effectively walled off, reserved exclusively for institutions moving by the ton. Retail buyers are left competing for fragments, paying confiscatory prices for whatever scraps remain. This is not a free market disconnect. It is a forced bifurcation between access and exclusion. And beneath all of this chaos, the vault data was quietly confirming the nightmare scenario. While retail shelves were emptying, the real damage was being logged quietly inside official vault reports. Inventory does not lie. Vault numbers are the autopsy of a market collapse. The end-of-day Comex clearing report was released at 5 p.m. Eastern, and the figures were devastating. Registered silver, the metal actually available for delivery, collapsed to just 39 million ounces. In a single day, nearly 3 million ounces vanished from the registered category. This was not routine reclassification. This was forced removal under delivery pressure. Now connect the dots between issuers, stoppers, and the inventory drain. One European bank delivered over 3 million ounces during today's session. Two American banks collectively stopped more than 4 million ounces. Yet the vault inventory dropped instead of remaining stable, revealing the real intent. The silver did not stay available. It was pulled off the market entirely. Metal was shifted into eligible status or loaded onto armored trucks, never to be offered again. These ounces will not be sold at $71 or any nearby paper price. They have been permanently sequestered by institutions that understand what is coming. 17 million ounces were demanded in 48 hours. Remember that number. Divide the remaining registered inventory by that demand rate. At current velocity, the exchange has roughly 2.5 days of metal left. This is not speculation. This is simple arithmetic. But the collapse is not isolated to New York. It is global and synchronized. China reopened its markets today, and the vacuum turned on instantly. Shanghai futures exchange silver inventories plunged the moment trading resumed. Total silver stockpiles fell to approximately 680 metric tons. 46 metric tons disappeared in a single trading session. That equals roughly 1.5 million ounces consumed domestically in one day. This occurred on the very first day the export ban went live. Industrial buyers are hoarding, not waiting, not negotiating. Solar manufacturers and electronics producers are stripping their own exchange bare. They know no new metal is coming in, and none is leaving. At this depletion rate, Shanghai's visible silver inventory lasts barely 2 weeks. Now zoom out and combine both hemispheres. New York is losing nearly 3 million ounces per day. Shanghai is losing over 1 million ounces per day. Together, visible global inventories are shrinking by more than 4 million ounces daily. Meanwhile, global mines only produce about 2 million ounces per day. That creates a daily physical deficit exceeding 2 million ounces. The buffer is gone, the math no longer balances. This is what a terminal squeeze looks like before price reacts. Banks saw these numbers early and understood the danger immediately. That realization triggered today's raid before metal vanished completely. And this brings us directly to the endgame calculation. Now the final question floods every inbox and comment section simultaneously. Did this raid break the banks, or did it reveal who actually controls the board? Many want to believe this was desperation, a last gasp before collapse. That belief is comforting and completely wrong. We have to abandon fantasy and examine cold, unforgiving balance sheet math. 2 banks combined took delivery of over 4 million ounces of silver today. At $71 per ounce, the total cost was roughly $314 million. To an individual, that sum is life-changing. To these banks, it is irrelevant. J.P. Morgan alone holds over $1.5 trillion in Tier 1 capital. Citigroup holds hundreds of billions more as a safety buffer. $300 million represents a rounding error on their balance sheets. It does not threaten solvency. It does not trigger margin calls. There will be no rescue headlines, no emergency bailouts. They did not raid silver because they were weak. They raided silver because they were early. Dollars are infinite to them, silver is not. They are converting printable paper into irreplaceable matter. This is not about profit this quarter. It is about survival next decade. They know next week the same money buys fewer ounces. Next month it might buy nothing at all. This proves the crisis is not financial, it is physical. Availability has replaced price as the dominant variable. The banks are front-running the inevitable revaluation. They are no longer the hunted, they are the hunters. They are squeezing competitors, retail buyers, and industrial users simultaneously. This is no longer a paper short squeeze fantasy. It is a bank-on-bank war for remaining inventory. Deutsche Bank versus J.P. Morgan is only the opening chapter. East versus West, insiders versus everyone else. The spot price on your screen is now a decoy. $71 means nothing when shelves are empty and vaults are bleeding. Inventory tells the truth, charts tell stories. The first 48 hours of this year rewrote the silver market forever. A 17 million ounce delivery spike shattered the illusion of abundance. Retail access collapsed, vaults drained, banks turned on each other. This was not a drill. The physics of scarcity have taken over. If you have physical metal, you hold leverage. If you are waiting for a dip, you are waiting for something that will never arrive. Do not watch the price, watch the vault. The war has begun, and possession decides the winners.